Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder from Seeking Alpha. Welcome to another episode of ETF Spotlight. And man, what a kickstart of the week. Am I right? We're watching the news. We're watching the stuff going on between US, China, and everything affecting the indexes. Well, today's a real treat for everybody because we're going into SPYI and QQQI from the legend guys over at NEOS Investments. And today we are joined by Garrett Paolella, who is the co-founder and managing director there. So Garrett, thank you for joining us on the program today.
Hey, Daniel, thanks for having me today. Looking forward to it.
Yeah, so let's dive in. NEOS Investment, can you maybe just kind of give us the umbrella view of what the firm is all about and how you created these products?
Yeah, absolutely. So NEOS Investments actually stands for Next Evolution Option Strategies. My co-founding partner, Troy Cates, and I actually have been some of the earliest pioneers in bringing option-based ETFs out to the market for well over a decade. And so for us here as a firm, we're really focusing on creating ways to drive tax-efficient monthly income and risk mitigation across that core building blocks of your portfolio.
Yeah, so there's a lot to unpack there. We'll talk about the tax side of it, but also the option strategy side of it. I mean, how did that kind of come about? Because it's almost like you guys were doing this ahead of the time of the option boom.
Yeah, so if you go back all the way to 2013, we brought some of the first products out. We were really focusing on ways that we could drive tax-efficient monthly income. And how do you do that with taking as little risk as possible for investors, but giving them really an alternative way to generate that outside of just equity dividend paying stocks or fixed income? And so as we thought about how we can generate that, we were doing these strategies for some of the major institutions, pensions, endowments, foundations, single family offices. And we said, listen, we want to democratize this, bring this out to all investors, retail, to individual professional buyers, and be able to produce results that can really just generate that tax efficient income across those allocations that traditionally maybe not be generating income, like the S&P 500 and SPYI or the NASDAQ 100 for us with QQQI.
So we're going to talk about these two funds. So the two largest at NEOS, and they're these option strategies. Maybe you can kind of dive into how those funds actually work on the option strategy for our audience, and then maybe talk about what sets them apart from the other ETFs doing something similar in this space.
Yeah, absolutely. So when you break down the products, each fund fully tracks their underlying respective equity benchmarks. So for SPYI, we fully replicate the S&P 500 equities and track that as the S&P 500 does. Same thing, QQQI owns all 100 NASDAQ equities in full replication. For the option strategies, they both have some similarities. The one difference they have is, of course, for the S&P 500, we're trading SPX index options, those linked to the S&P 500. And for QQQI, we're trading those NASDAQ NDX index options. Other than that, what we want to do on a monthly basis is really put together a laddered portfolio of short cover calls, meaning we're going to sell call options at various different strike prices, so levels to the S&P or to the NASDAQ 100, to generate a positive income coming into the portfolio. That's going to be really the key attribute to meeting our monthly distribution rate. And the way we look at those options is we, as I mentioned, ladder them out, but we also don't write in the whole portfolio. So our differentiation and part of the way our products perform is that each month our models dynamically set those call options in order to do two things. One, first, meet that income need. Second, look to appreciate as much as we can with the equity market. So if you think back over the last, month in April, or even over the last 6 weeks, right, we want to marry that income generation with upside appreciation because these are equity allocations. And so for us, the idea is we're going to distribute investors a monthly distribution anywhere between 10 and 15%, depending on the product that you're in, because it's all driven off of that volatility level of the underlying index, that being the NASDAQ or the S&P 500, which helps generate the income for the portfolio.
So just to clarify, so you said laddering these out. So you're selling calls over multiple strikes on a monthly expiration. Is that correct? Not like weekly or a daily even, but you're looking focused mainly on that monthly time period?
That's correct. Yeah, we like to roll at the end of the month, and we look out to a duration roughly of 6 to 7 weeks to start, but then we're rolling. So we're rolling actually with a little bit of time left in it. And for us, the way we view that is you're getting the best risk reward from the income generation that the option portfolios be able to generate for you.
Now, QQQI just won the Best New Active ETF award this year. So congratulations on that. Just want to make sure that we plug that. That's really remarkable and something really to be proud of. But I'm kind of curious, like, how is it that you can just, like, are you going for Russell next? Are you just going index by index? How have people not already taken over the space? I mean, is there just massive opportunity here?
Yeah, so thanks for obviously the accolade. We're excited about the award. It was great. It was an industry recognition from several independent judges that picked us out over firms such as Vanguard or Fidelity, and other innovative product that was brought to the market. I think as we think about it, is we've always been a solutions provider. We want investors to choose what views they want to espouse from either a directional bet from a sector or an index level, or it fits their asset allocation. We actually do have a Russell 2000 already out there. That's under IWMI. But as you think about our overall product suite here at NEOS, we actually have 11 products, and that covers not only the equity high income side, we cover hedged equity, we cover various levels of fixed income, and then also alternatives with real estate or Bitcoin. So for us, Daniel, it's really about making sure that we're just a solutions provider and we can leverage each one of those indexes or allocations and then let investors choose their market views, the risk tolerances, or really income needs that fit their broader part of their portfolio.
Yeah, it's brilliant too. So talking about SPYI, QQQI, how have they been doing since the inception of when you launched those?
Sure. So we've been really pleased with the overall performance. The reason you invest in these types of products are obviously that monthly income, but you want to compare that relative to overall total return because this segment has been growing. I think there's over 600 option-based ETFs now in the marketplace. We launched the very first, 2 and 3 way back over a decade ago. And so when you think about performance for us relative to kind of our direct competitors in the sector, we've been very pleased that we've had a stronger total return matched with that income generation and really that tax efficiency. And so I think that's something for all income investors to note. When you're looking at income allocations, they tend to be taxed in an ordinary income, even a short-term capital gains, which ultimately is at ordinary income rates. We really strive to make the investments as tax efficient so that net after-tax yield is going to be as high and as close as comparison to that gross income being generated at the fund level.
So we're talking about these are kind of a product where an investor comes in, they buy shares of the ETF, they get that income coming in, but then you get that long-term capital gains, right? Just want to make sure I clarify that.
Yeah, that's correct. So there's 2 ways, right? If you obviously buy at a certain price, hold and sell in the future, you get long-term capital gains treatment. But really the differentiation with us is we're trying to convert that short-term, that ordinary income for that monthly distribution into deferred long-term capital gains tax, meaning you pay that in the future when you sell the fund, or if you pass it on in estate planning. It's not so much that you're going to get a distribution every month and then come tax time in April, you got to go write a big check out to the government. We want to make sure that you're trying to achieve as much of that as a net take home as you can on that short-term monthly basis.
Now, Garrett, some investors may be watching this and they go, well, I've heard about options. I've heard to stay away from them. Those strategies are too risky for me. They're too risky for my portfolio. And especially within volatile markets like we've seen over the last couple of months. I mean, what should investors know about buying a fund or like yours, like the SPYI, getting that income? Because how is it there's the risk aspect, right? How do you pick those strike levels where you're not going to get hit with the risk of, losing money on that play?
Yeah, so I think it's important to always do your homework, right? Whatever product you're looking to invest in, know what it does and what it doesn't do. I think that's what we focus a lot of time on with investors here. But as you're thinking about looking at these types of covered call products, the biggest risk we always assess is the upside capture. It's not so much the downside, right? You're going to participate down with the equities, minus the income you generate. So a lot of our products, SPYI, QQQI, right, they're targeting around 100 basis points, 125 basis points a month of income. That is the means of what your downside protection is. So it's not meant to be a hedged product. It's really about to be income generation. But the way we're mitigating the risk to the upside is that dynamic approach. We're looking at several factors in our models, which are all rules-based, but what we're trying to say is what is the greatest probability of the expected outcome in each one of those indexes over the next 30 days. So when we set those option strikes, we want to look to generate as much upside appreciation as we can in those really strong equity months. But if the markets are flat or down or even significantly negative, you got to make sure you're generating the income level to meet the distribution. That's a key consideration when you look at these types of products overall, is how do you really make sure that regardless of what market event you're in, what market cycle, you have a positive part of your portfolio that's going to be delivering that monthly distribution.
So I'm sure somebody's watching right now and they're going, well, okay, can you walk us through how the funds have done since February of this year during the volatile markets? Can you shed any light on how you've been doing?
Yeah, sure. So year to date, we on SPYI, we are roughly flat. So we are equal to outperforming the S&P 500. But I think if you look at different timeframes, we captured a lot of the upward move coming in through January and February, but then really through that March and April, that high volatile time, we did exceptionally well in our opinion because we were able to generate the income level, but not cap the upside when the market rebounded. That's, I think, a really big characteristic when you're looking at these types of products, is that most of our competitors have rolled their options down through the middle of April, right, or all throughout April. And so this big rally back that we've seen off of the lows hasn't been able to be captured. Surprisingly enough, as we actually think about QQQI on a year-to-date basis, this is all just Bloomberg that I'm pulling. QQQI is flat versus most of our competitors down anywhere from 4 to 6%. And so we're really pleased that income generation has been able to be an outperformance. Not that we try to target it, but ultimately with QQQI, which is part of why it won the award, we've actually outperformed the NASDAQ 100 on a total return basis. And so if you think just the way that market has kind of ebbed and flowed and the income generation to protect those kind of drawdown negative months has been able to help us compound to be, still even this year to date, outperform the NASDAQ by roughly about 100 basis points.
All right, Garrett, one more question before we get on out of here. This has been all extremely insightful. Thank you for taking the time. You've been doing this for years, right? How are the majority of investors that you hear about that are investing in your funds? I mean, are they putting them in their portfolios for a buy and hold strategy for a year, for 6 months, for 3 months? Do you have any insight on how people are actually using your fund?
We are. So we have been doing this for multiple decades, but pioneer in the ETF space. These are long-term buy and hold. These are income allocations that are meant to complement areas of your portfolio. So if you think about all of our products, not SPYI and QQQI only, but all of them is really meant to be an addition into your portfolio allocation in those respective areas, your equity sleeve, your fixed income, your alternatives. And what we see is long-term holding patterns, being able to receive that monthly distribution on a tax-efficient basis. That's really helping you kind of compound or meet your overall investment objectives. They're not to replace, full long equity exposure. So we've been doing this a while, and that's why we built the products out to be that solutions provider, Daniel, so that people could choose what allocations fit best, for their rest of their portfolio mix.
And you guys have made a lot of buzz in the space. So I can't thank you enough. Thank you one more time for coming on here to ETF Spotlight this week. It's Garrett, everybody, co-founder and managing director over there at NEOS Investments. Check out SPYI or QQQI here on Seeking Alpha. Follow them. Maybe add them to your portfolio if you think they're right for you. It's up to you. But everyone, thank you for joining us this week. We'll see you next week for another ETF Spotlight. Take care.